Welcome to the channel. My name is Jermaine Williams. I run a life insurance agency where I train and mentor other life insurance agents to build successful careers. So if you're looking to get into the industry, maybe get your life insurance license, you can definitely reach out through the link in the bio. Or if you already are licensed and you're looking for a new home, more mentorship, better training, hopefully better training, right? I'm assuming better training. Click the link in the description box and then we can set up a consultation to see if it's a good fit. I make no assumptions that you're a good fit for us or I'm a good fit for you, but at least we can have a conversation and see if it makes sense. All right, so today I'm going over the top 5 questions that I get asked regarding the IUL. Okay, so I'm gonna go one by one, and by the end of this video, you should have a better understanding of how the product works and some of the different features. Okay, so first question I get is, what is the minimum to start? So what's the minimum to start an IUL? And I'm gonna use minimum as max funded. So I'm gonna say the minimum to max fund the policy, right? So max funding, I'm using guideline annual. So that's the most you could put in, because if you go over the guideline annual, you create a MEC, which is a taxable event. So we don't wanna do any of that. So we wanna stay within IRS guidelines. So I'm gonna use the guideline annual. So for a 20-year-old, if they wanna set up an IUL, it would be $123 a month to max fund an IUL. Right now, I'm a broker, so I have access to many carriers. So these numbers may be different than the numbers you got from your local insurance agency or whatever it may be. But these are true numbers. I ran them right before the video to make sure no rates have changed. So I'm looking at the minimum death benefit someone can get, and the maximum cash value is a max funded policy. So if you're 20 years old watching this and you have $123 a month, you can get started in the IUL and have it max funded for max cash value. Now, if you're 30 years old, that's $160 a month. So $160 a month will get you a max funded IUL at 30 years old. If you're 40 years old, that's $213 a month to get a max funded IUL. And if you have questions or you want to see these numbers or you want to talk about it, I'm also including another link in the description box below. Those will be more for people that, are on the client side, not necessarily agents that want to work with me, but more clients to, get help with the product. So now moving on to 50-year-olds. So if you're 50 years old, to max fund an IUL will be $291 a month at 50 years old, right? And these numbers impressed me. I didn't know they were going to be as low. Now, obviously, you can put in more. So if you put in more, we'd have to adjust the death benefit, but you could put in more. But if somebody says, I want a max funded policy with the smallest amount of money out of my pocket, this is what it will be. Now, because these policies are max funded, that you can put in less, right? It's easier to go down than it is to go up. So if the 50-year-old came to me and says, hey, I know the max funded amount is $291 a month, but can I get it started with $225? I'm going to tell them, yeah, we can get you started. Obviously, you want to max fund it. That's the goal, of max fund it. But at least it's locked in. Your grandfather entered the price, because we never get younger, because age is a big factor in the cost of insurance. So we never get younger than we are today. So at least that's locked in. And down the line, you can start max funding it. The sooner, the better. So I would say it can even go down to a lot less, right? Because there's a minimum threshold and maximum. So if you reach out, we can give you the range that you can get in, so you can actually get the policy set up. So 50-year-old will be $291 a month. And the last one I ran is a 60-year-old. So if you're 60 years old and you want an IUL and you want it max funded, $412 a month will get you a max funded IUL. All right, so I ran with multiple carriers. This is the carrier that had the least amount. If you reach out, I can help you one-on-one. They're not sponsoring, so I'm not just name dropping companies, but that gives you a good scope, a good idea of how much it would cost to set up an IUL and have it designed for cash value. Second question is, can I lose money in my cash value if the market were to drop? So if the market were to crash. So the answer is no. So the market dropping does not negatively impact your cash value. So your cash value inside of an IUL is an index strategy. And what it's doing is following an actual index. So the index is the actual market. The strategy is the formula for which it follows that market. So if the market goes up, typically IULs, I'm going to use the cap, right? Not all IULs have caps, but I'm going to use the cap. So the IUL has a cap and a floor, meaning the cap, let's say the cap is 10%, that's the most you can get. So if the market does 5, you'll get 5 credit to your IUL, 5% credit to your IUL. If the market does 10, then you get the 10% credit. But if the market does 15 and the cap is 10, you still only get 10% credit. So that's the cap. But there's also a floor, meaning if the market were to go negative 10, you're locked in at 0. So zeros are heroes, what they say. So you're not gaining any interest, but you're not losing any money because your money's not directly in the market. It's mirroring whatever the market does with that floor and that cap, right? So you have the ceiling, the most you can get. Why is someone willing to have a cap on their funds? Because they like the fact that they have the security, the safety net. If the market were to crash, they're not going to lose any money based on negative market performances. Next question is, how soon do I have access to my cash value? Okay, so assuming we're max funding the policy, so you have money going to the cash value immediately, it varies from carrier to carrier. The one carrier that I know of allows policy loans as early as 15 days. A lot of companies are at 30 days. Some companies are at 1 year. So that's an important question to ask. Obviously, if you're looking for funds within a year, you want to make sure it's accessible to you because that'll be defeating the purpose. But you want to speak to your agent so they can, instruct you like, okay, this policy is a year, this policy's 30 days. There's going to be pros and cons. So let's say the year policy has other features that you like, then the 30-day policy doesn't. But you don't plan on taking policy loans within the first year, so you can kind of bypass. Even though it sounds great, you can have loans in 30 days. If it's not fitting your overall picture, it may make sense to go with the one that gives you loans after a year. If you don't plan on taking loans for 10 years, it's not going to matter either way. So 15 days is the soonest. I see a lot of 30 days, and then you also have 1 year. Next question, do I have to pay back my policy loans? Okay, so the direct answer is no, but I need to give you some context. So if you have cash value built up, let's say, I don't know, you're 5, 6, 7, 8, 9, 10 years out, and you have cash value built up and you decide you need to use the money to do something. I don't know, you got into real estate, you want to do something with some real estate or whatever it may be, you pull the money out, okay? Now, you don't have to pay back that loan, but I always tell people that the alternative would be you getting the money from a bank. So if you got the money from a bank, you would pay back that loan. You'd have to pay back that loan. So I always say treat your own bank. So if you're going to treat this like a bank, treat your own bank with the same respect that you would treat a institutional bank, right? So, but you don't have to be as rigid on yourself. Say, okay, I start make payments immediately. You may say, I'm not going to pay back for another 2 years, but pay it back, right? If you can, right? So in that situation, I would say you want to pay it. You don't have to, but you want to pay it back. Now, in the sense where you're retiring, so let's say you're using this for a tax-free retirement income stream, then in that situation, do not pay it back because it makes no sense to pay back a loan in retirement. In retirement, you're trying to reduce the amount of money leaving and you're just taking more money in. So what happens is, let's say you have $100,000 in your cash value and you've taken out $80,000. So you have an $80,000 outstanding loan and you were to die. The insurance company has used your $100,000 as collateral to give you the $80,000 to begin with. And why? Because they know if you can't pay back the loan, they'll take that $100,000, pay back themselves the $80,000, and then they'll make themselves whole. So it's like the buy, borrow, die method. So you don't have to technically pay it back because it will be paid back on your behalf based on the amount that you have inside your cash value, which would be connected to your death benefit anyways. So no, you don't have to pay it back, but depending on what stage of life you're in, determines if it makes sense or not to pay it back. And the last question is, how does this affect my taxes? So money going into the policy is after-tax money. So after-tax money means, you got paid at your job, taxes were removed, and then whatever was left over made it to your bank account. That money that's in your bank account is after-tax money. You've already paid income tax of that money. So that's the type of money that goes inside of a life insurance policy. It receives after-tax money. Once it goes into the policy, it grows, and whatever the growth is, you're able to access that money tax-free. So if you've put in $20,000 in premium, but then your cash value says $100,000, you're able to tap into that 100,000 and not have to pay income tax on that money at all, right? But when it comes to like writing off, it's not going to do anything for you when it comes to writing things off. Obviously, if you have a business, that's a different scenario when you get into business and corporations. But essentially, the money that you put into the policy is not a tax deduction. However, all the growth and all the accumulation you receive out of the policy when you take it out, you're able to bypass taxes 100%. Because when you're taking the money out, you're taking the money out as a policy loan. And loans are not taxable. You pay interest on loans, but you do not pay taxes on loans. And obviously, when you die, then the balance that you didn't use plus your death benefit pays out to your beneficiary income tax free. So that's how it works when it comes to taxes. So if you have other questions, put them in the comment section. I'll make a part 2 once it adds up another 5 questions. But hope this helped. Like, share, so YouTube knows it's a good video. Put a happy face in the comment section, like I always say. But other than that, reach out if you need help, and I will see you in the next video.